Welcome to All Things Policy, a daily podcast supported by Pragati, a flagship media initiative of the Takshashila Institution. We're a bunch of policy nerds based in Bengaluru, and we like to bring a fresh perspective to Indian affairs and an Indian perspective to global affairs. So grab a cup of coffee, sit back, and join us for today's chat.
Hello and welcome to All Things Policy. I'm Manoj Kewalramani, and today I have with me a special guest who's going to be telling us a little bit about, actually a lot about, Chinese overseas finance, and I couldn't think of a better person to discuss this with. My guest this week is Samantha Custer. She is the director of Aid Data's Policy Analysis Unit. Her research examines the influence of development investments and public diplomacy efforts, generates new evidence on the use and impact of open data, and leverages surveys to learn from the experiences of decision makers in low and middle income countries regarding the impact of external money and ideas on domestic policy reforms. Samantha, welcome to the show.
Thank you for having me, Manoj. It's a pleasure to be here.
So I'm really looking forward to this conversation. I met you in Delhi a couple of months ago now, and it's just so interesting to see because we get so much narrative around Chinese overseas lending in finance, and all of that narrative tends to be, there's so much sort of politicization of it. So it's really useful to actually get the data, and there's so much opacity from Beijing that it's difficult to get the data. So it's truly fascinating work that you do. And I was hoping that we could spend the next 30 minutes just trying to pick your brain to try and understand through data what exactly is happening with BRI and Chinese overseas finance. Is this a debt trap? Is this strategic thinking? Is this money chasing better outcomes? What exactly is going? So I'll start with sort of my first set of my basic question, just for people who may not have had the sense of what's happening, is I want to just understand the scope and scale of Chinese overseas finance, and also who is providing all this money? Where is all this money coming from?
Yeah, it's a great question to start with getting our supply side facts right first. So to set the stage, when we're talking about China and China's bankrolling of overseas development, it's important to recognize that this is happening at a scale and speed unmatched by traditional bilateral and multilateral donors. So by our estimates, China has bankrolled nearly 17,000 overseas development projects worth over $1 trillion across 165 countries in the last 2 decades. So to put that in comparison, that means that China is now outspending the U.S., previously the world's largest development donor, by 2 to 1. And the sizes of these projects can be quite large. And so you're dealing with sums of money that are much larger than what is supplied by traditional donors. So the mean dollar size of an average Chinese finance development project is probably something in the order of $122 million. And in the first 5 years of BRI's implementation, we were seeing the number of mega projects that China was financing with loans worth $500 million or more tripling during the first 5 years of BRI. So this is pretty big money. And I think one of the other unique things that China is doing here is a focus on infrastructure-led growth. So here you're talking about physical infrastructure, such as investing in roads and ports, electricity, telecommunications, but also a lot of digital infrastructure as well. And if you are a local politician in a low and middle income country that thinks infrastructure is a gateway to economic growth, then China is often viewed as the only game in town. But, I think what's also important to remember when we're talking about China is that even if the volume of what Beijing is offering is larger, it's typically offered with somewhat less generous terms than traditional donors. And here we're talking about not only aid, but debt. And, for this reason, we actually see that China has become the single largest bilateral creditor to low and middle income countries around the world. And what this means in practice is that China lends vast amounts of money in the form of loans and export credits to potentially risky markets to pursue development projects. So in practice, across almost $1 trillion of assistance that China has provided, about 81% of that is in the form of debt. Only 12% of what China is offering could be considered grants or traditional aid. If you compare the terms of these things too, Beijing's loans are actually seldom concessional and are often approaching market rates. So if you compare a typical loan offered by China, for example, you're talking about a 4.2% interest rate, a repayment period of less than 10 years. 60% of these projects usually involve some form of collateral, repayment guarantees, credit insurance. 89% of these projects are typically implemented by Chinese state-owned enterprises. This is often a requirement of getting access to Chinese financing. This is very different than what you would see with a Germany or a Japan, for example, because there you're talking about something in the order of maybe a 1.1% interest rate, a repayment period of 28 years, and typically you're not talking about the same collateral or procurement requirements.
I wanted to pause there to just sort of have a question between, there's only quite a big difference in what other lenders are offering and what Beijing is offering. And also the fact that it's essentially Chinese state-owned enterprises which are carrying out these projects. What is it that makes Chinese lending attractive to developing countries? Because this doesn't sound like very favorable terms.
Yeah, I mean, it's a good question, right? Like, what do leaders across the global south view as attractive about working with China? I think one thing is speed. If you take your prototypical infrastructure project implemented by China, this is actually happening 2.5 times faster than that which would be implemented by a World Bank or a regional development bank. Now, that doesn't sound very good, right? It might be tempting to beat up on the World Bank or the Asian Development Bank, but there's some important differences as to why that is the case, and there's some good things and some bad things about that. So one of the reasons why China's ability to implement projects is faster is because they typically don't require the same types of environmental and social safeguards that would be included in what other donors require. And so this means that you can do it faster, although it does mean that there's a greater likelihood of some negative spillover effects from these projects. The second thing that China tends to do that allows you to fast track these projects is that they seldom use an open and competitive procurement process. And so these projects are being awarded as part of backroom deals. So there are these trade-offs there, but I mean, I think the speed is definitely one of the appeals. I think also, as I alluded to before, China is one of the few actors that really invests at scale infrastructure. And so often, if you want to work on an infrastructure project, people are looking at China. Other thing that's important to recognize here is that China is often seen as providing additional plus-ups on top of the assistance it offers. So accept this particular loan for building a power plant, and that also opens up, export markets for your bananas, and it will unlock, tourism revenues from Chinese tourists visiting your country. And so it's not just strictly the terms of the lending that are in play here, it's often the whole package.
That's fascinating. So if essentially the lending is also part of, not just in the context of the project that you're initiating, but it's also in the context of the broader bilateral relationship and other dimensions of that bilateral relationship, which sort of is a neat segue to the next question that I had, is that firstly, which are the areas and sectors in which much of this lending has happened? Which are the areas and sectors where a lot of the BRI money has gone? And are we seeing some sort of a change in the pattern of the lending? For the last few years, we've been hearing that for domestic economic reasons and for the fact that some of these projects have not necessarily yielded the kind of dividends that one would have imagined, there is sort of some degree of a slowdown. Like Xi Jinping had talked about, wasteful investment and all of that. So there has been some sort of a slowdown. So firstly, which are the sectors and on slowdown? And an added question to that is that what are the kind of objectives that Beijing is looking to pursue? Because we keep hearing about part of this being political, that you want to, so for example, in case you're investing in countries which maybe, which recognize Taiwan, you have a political motive behind that. But in some cases, in Pakistan, for example, we hear constantly that the investments, say in Gwadar and other places, are strategic investments. So what's the balance between what's happening with, are these investments of strategic nature? Are these investments of economic nature, of money chasing more money? Or are these investments of political nature? So yeah, the sectors and the nature of the investment.
Yeah, these are great questions, Manoj. So in terms of sectors, China certainly has projects across all of the different sectors we could imagine, but it does not have a balanced portfolio. And I always like to follow the money because that tells you a lot about the revealed priorities of what people really care about. And when it comes to the overall dollars and the value that China is supplying, it is squarely focused on infrastructure. And here I'm talking about like top sectors would be energy, transportation, industry, mining, and construction. These typically are the big ticket sectors that you see the vast majority of money going into, and it's not even close. Like those three sectors alone, probably you're talking about 3/4 of China's overall investments or more are in that area. And then, the rest goes to an odd assortment of different sectors. In terms of the profile of this lending, it has started to shift a little bit over the last few years. What I see happening more and more is actually a shift from China bankrolling new infrastructure projects to starting to bail out some of the old infrastructure projects as they start to run into difficulties of being repaid and servicing the loans. So there's a little bit of that going on. Certainly, there's been a lot of focus and interest in China's launch of the Global Development Initiative and the Global Security Initiative. But what's interesting is that you don't see a lot of shifting quite yet in its project portfolio in that regard. In terms of also how is the profile of this changing, one of the things that's striking to me is that the players involved have become much more complex. So before the Belt and Road Initiative, so back in pre-2013 days, really a lot of the financing was channeled by two big actors. You're talking about the policy banks, so China Development Bank, China Exim Bank. That accounted for the vast majority of what China was doing. If you fast forward to the Belt and Road era, this is much more complicated. So now you're starting to see a 5-fold increase in lending from a large circle of state-owned commercial banks. So you're talking about Bank of China, Industrial and Commercial Bank of China, China Construction Bank, etc. You're seeing a lot of syndicated lending where you have multiple banks now that are involved in these transactions. So it's getting quite complex. And I forget the last question that you posed to me.
Yeah, I mean, that's me throwing in too much at one go, being greedy. But yeah, the last bit is what I wanted to know was, we hear a lot about, whether Belt and Road is succeeding, failing, and we're going to have a third Belt and Road forum this year. And I'm sure that when Beijing holds a forum, it'll call BRI a success. But in large parts of the world, we hear the discussion of failure. But success and failure depends on what the objective was, right? So is Beijing's objective when it comes to these investments, is it about, are these politically driven, politically motivated investments? Are they investments which are motivated by strategic purposes and therefore it doesn't matter if they're economically unviable? Or is this a case that you had trillions of dollars in reserves and it wasn't generating enough value and therefore you thought that you wanted to expand? Is this sort of money chasing more money? What is the motive behind these investments?
Yeah, it's a great question. I think my answer would be that China has multiple objectives for its financing. And sometimes those objectives work together and sometimes they can be at cross purposes with one another. So one way you can answer that question is actually looking at the terms of these projects. And what's interesting, even though I said that the vast majority of China's financing is in the form of loans approaching market rates, that isn't always the case. And so this raises the question, if you're China and Chinese leaders, when might you be more or less inclined to give money away cheaply? And understanding the exceptions to the rule is helpful in understanding China's multiple objectives here. So what we see coming out in our data is that China tends to provide access to more generous financing. So you're talking about grants or no or low interest loans in cases where it's trying to boost its reputation and favorability in the eyes of foreign leaders and public. So think about bankrolling a stadium in Senegal or helping with renovations of the Maldives Foreign Affairs building. Neither of these are big moneymakers for China at all, right? But they definitely make an impression if you're trying to win over foreign elites from a political perspective. But of course, we know that that's not where most of China's money is going. If you look at this, then you can see that China's primary, their not only motive is economic. If you see a high dollar value project financed with high interest loans, almost always talking about investments where China expects an economic return. So think about a copper deposit development project in Kazakhstan or a coal-fired power plant in Pakistan. These are things that China expects an economic return on. And the reason for that is China has an Achilles heel in its industrial policies. So China over time has accumulated a vast amount of capacity in its construction, steel, engineering industries that is beyond what the country can absorb domestically. And then in parallel to that, through 3 decades now of trading surpluses, China has actually accumulated a vast balance of foreign currency reserves over $3 trillion. So if you take the excess financial capacity in its state-owned banks and the excess implementation capacity of all these state-owned firms, China is facing kind of a pressure to push all of that out externally to try to get some sort of productive way of getting return on those investments. So economics certainly is a primary driver, although we do see indications that it's not the sole one.
Thank you for listening to All Things Policy. We'll be right back after a short break.
If you're building these, parliament buildings in other countries, and if you're building a foreign affairs ministry or a stadium, and part of these are sort of projects to try and create a positive perception in these countries, are we seeing that yield dividend? Does the data that you have tell you that in terms of perceptions, favorability of China in the global south, which is where it's investing, has been on the upswing? Has it improved? Because favorability in the developed world has obviously been declining. But in the global south, have these projects yielded that outcome?
It's an interesting question, Manoj. And I would say, I think we're seeing some mixed results, actually, for China in this. So on some measures, I think China is getting some of the reputational dividends that it wanted. So if you ask leaders in the global south, and I field surveys of policymakers in 140 low and middle income countries, a couple of things come out as true. So one is that in many regions of the world, if they are looking to foreign countries as models for development to which they aspire, China is often one of the most favorably viewed models as like, oh, we should be exemplifying what China is doing. They seem to have it right. And so that's a pretty bold statement on the part of leaders around the world saying like, China's doing something right. We should learn from them. I think also too, if you ask leaders about who their preferred partners are in different sectors, and you can choose from a variety of alternatives, in some areas, China is by far and away the preferred partner. And in areas related to infrastructure, again, China is this is the area of focus for China. It's what it's known for. And leaders clearly have a demand to work with China. But it's also clear that leaders see trade-offs. So we actually asked leaders about what they viewed as the economic, environmental, and governance impacts of Chinese finance development projects in their countries. And in terms of economics, I think leaders across the global south generally give China's investments kind of an A- or a B+. Like they view this very, very favorably, generally a net positive. The opposite is true in terms of the environment. Leaders know that Chinese finance development projects, maybe because you're not including those same safeguards I talked about earlier, they're concerned that this is having some negative repercussions in terms of increased pollution, lack of sustainable natural resource use, and the like. Governance is the one area that is the most interesting for me because it's definitely a clear trade-off. Leaders generally view China's projects as improving access to quality services for their local populations, which is a great thing. You want that from development projects, but it's coming at the cost or expense of increased corruption. And that is a major concern and constraint for countries. So they see these trade-offs definitely in the mix. And I will say that this also tracks with what a lot of what we know about the objective facts of Chinese development projects. So when we've looked at the projects that we track, by our estimates, a third of BRI projects are associated with some form of negative spillover, whether it's corruption or local protests or problems of implementation. So I think China's making an impression. It's definitely generating some goodwill and desire to work with it. Leaders recognize some of the trade-offs. And I think you see differences depending upon where you are in the world and how long of a track record you have with China. So what's interesting to me is that some of the perceptions of China as a development partner and Chinese projects are more polarized in places like East Asia that have worked with China for a longer time. There's much more enthusiasm in places like Latin America and Africa, which, this is a newer relationship for them.
This is fascinating data because it gives you something to think about when we think about what sort of policy responses, say, India, the Quad, the European Union should be thinking about when they think about potentially, if not competing, but at least being players in terms of the infrastructure game in much of the global south. And I was wondering, if you're not going to be able to compete with China on time, project delivery, and the trade-offs that come with that, I mean, you can potentially compete dollar for dollar if you have a set of countries that come together. And you may not have necessarily the infrastructure expertise that China today has. Is it worth then competing on these factors by saying that, well, our projects are higher quality if you're not going to be able to meet the political timeline in country X, where a politician might have 4 years or 5 years of his term and they might want to deliver on a certain project within that time? Is it worth doing that, or is it worth saying that a lot of the infrastructure piece is not something that we can compete on? So we're going to compete on the other aspects of development where China doesn't do well. And that's going to probably give us significant influence to be able to counter whatever we may see as pernicious Chinese influence. Would that be a smarter strategy? Or is it smarter to say, no, we're just going to compete head on infrastructure, although we are playing a weaker hand?
Yeah, I get asked versions of this question a lot. And I think my answer would be, if you're trying to out-China China, you are by nature, the way that you're approaching that question, kind of at a disadvantage, right? Because you've made it all about China. So they are the incumbent. We're not going to compete with that. And so what I would say is, let's not try to outbuild or outlend China when it comes to infrastructure. But as you alluded to in your question, there's a number of different options on the table for the Quad or other actors. So one is in looking at ways to curb the pernicious downstream effects of Chinese debt finance development, right? So the objective is not to get countries to stop working with China because, China offers, a lot of new capital that's put on the table that countries can work with. But the concerns of that capital is that, does it create opportunities for political leverage, or does it create economic distress for countries in ways that make them more vulnerable to Chinese influence or to seeing them not achieve their development goals? And so I think there are ways to deal with that in the fact that if you look at, actors like the United States, for example, or the United Kingdom, they, when it comes to preferred partners in the governance and rule of law sector, these Western democracies tend to be actually continuing to have a comparative advantage vis-a-vis China or others. And you think about governance and rule of law as the cross-cutting sectoral issue, right? So how do you improve accountability of the people that are making decisions about what loans to take on or what projects to take on? How do you build the public financial capacity of civil servants to be more effective in estimating the revenues and the costs of project and making sound decisions? How do you get parliaments involved in overseeing these transactions to reduce the likelihood of corruption or collusion? So these are things that you can do through governance and rule of law in an area of strength for China's strategic competitors, but in a way that curbs the negative aspects of Chinese influence. I think also, too, if you're an actor like India or Japan, what's interesting to me is that in an area like environment and natural resource management, these actors are actually some of the most preferred partners of all. And these are areas of relative weakness or risk from Chinese finance development projects. And so there's a real opportunity there, I think, for actors like India and Japan and other regional powers to play a role in how do you help curb the negative environmental impacts of projects? How do you increase resilience? And then finally, I think, maybe infrastructure, it's not a binary, do you get involved or not, but maybe it's a question of in what subsectors can you carve out niche areas of focus? And I think when it comes to renewables or climate-friendly related aspects of energy production and the like, this is an area where China is talking a good game, but they don't have a lot of comparative advantage as yet. But I think some of these other actors might. And so, if you can increase the appeal of these types of solutions for low and middle income countries to see that, hey, it's lower cost to do this. You're going to have fewer negative downstream implications of this. I think that could be a play that would be competitive.
All right. So don't out China, find your own game.
Exactly.
That's it. Okay, fair enough. I have a last set of questions because I wanted to focus on, we talked about debt a little bit earlier. I wanted to talk a little bit about the restructuring conversation that's been currently happening, whether it was with regard to Sri Lanka or with Zambia. Those are two examples that come to mind. But in general, there has been a conversation about how do you approach debt with the developing countries. And previously, from what I understand, and even at present, Beijing's focus has been to deal with these issues bilaterally, generally very discreetly. Part of it has been that you don't necessarily want to talk about it in public because you don't want to incentivize others to seek that kind of restructuring or similar deals. But today, Beijing is saying that, hey, look, we're not alone responsible for the debt difficulties that are taking place for these countries. So why don't you have all actors, including multilateral development banks involved in this process, which comes with its own challenges. So I firstly wanted to get a sense of whether the scale of restructuring that's taking place from Beijing's perspective in Chinese debt with developing world, is that leading to sort of a rethink among countries that have taken money from Beijing about the hidden costs and hidden challenges of this kind of lending?
Yeah, it's a big question, Manoj, and a very important one right now, because if you are China and you're looking at your own project portfolio of all of those 17,000 projects that I alluded to earlier, 60% of that portfolio is now supporting countries that are in the midst of debt distress. And that's up from 5% in 2010. So if you're China, you're beginning to worry about this. And it is one of the downstream consequences of investing at scale in risky markets. Another challenge for China, of course, has been that, somewhat different to, what the World Bank would say. China doesn't necessarily put limits on the borrowing of another country, whereas the World Bank might say, oh, no, you've borrowed too much. You're past the point where this is sustainable. You need to back off. China won't do that. I don't think that, some people say there's some media articles that came out around the time of the big Hambantota port reversion where that basically is now being implemented by China. And people said, oh, look at how China got Sri Lanka to cough up port. And I don't think that is a fair or realistic characterization of what was going on. I don't think China wanted Sri Lanka to not be able to repay its debts. I think that doesn't make sense. I think it is a function of the collateral requirements that China puts on these things. And, the Sri Lanka case is an interesting one because it shows the problems of debt finance development more broadly. China is a major supplier of debt to low middle income countries, but it is not the only supplier of debt. And countries like Sri Lanka have taken on vast amounts of debt from the private sector as well. So international sovereign bond markets. So, it's important when you think about China's role in all of this, it's not solely Chinese debt that's breaking these countries back. But at the same time, China has sometimes been an enabler of poor behavior, where they are very responsive to what political leaders in another country want. And if they want more debt finance development, China will keep bankrolling it. And then when they run into trouble, they want these countries to come to China and say, how do we help you out? And so you see China be getting involved in the emergency lending game. Basically, if countries are starting to run into problems repaying their debts, how do you boost liquidity? As you see China, in the last 5 years, we've seen huge amounts of these emergency lending payments. So probably on the order of $40 billion on average per year. And this is really about propping up countries' ability to repay these loans. And it's not just from Chinese loans, but it's kind of, more broadly, how do you keep these countries in play? Now, if you're China, you're kind of going long here. Your risk and your dependence upon these countries to repay these loans is becoming more and more dire. And the challenge when countries default, and this came out in the Sri Lanka case for sure, if you're going to the International Monetary Fund, they're going to put in place stabilization measures. They're going to put in place requirements of basically a pecking order or a sequence of who gets repaid first. And China doesn't want to be in a position where it's not getting repaid first. And so this was like a lot of the resistance early on for why they strongly were opposed to the idea of Sri Lanka going to the IMF. And I'm saying the Sri Lanka example, but you can see this playing out in other places. In China's strong preference would be not to go that route. And so you do see them more open to restructuring of different types of loans and projects. The kind of seizure of assets is very unusual, actually. Much more frequently, it's restructuring, not outright loan forgiveness, but kind of restructuring of the timetable of debts or maybe the level of repayment. That is much more common. China doesn't want countries to fail, but I think it has relaxed some of its posture because of all of the negative press that it's gotten about being resistant to Sri Lanka seeking international support. And so you see them starting to be more open to this idea now.
It's fascinating how, when it comes to this money, the West is worried about funding what it sees as irresponsible Chinese lending, and China is worried about not wanting to be being paid as the last entity who's being paid. And it's a tricky space for developing countries to find themselves in, because you can't necessarily lose anyway. My final question to you is, and then you could answer it as briefly as you would like. It sounds to me that in some way you talked about this model of debt finance growth, which is debt being used to finance infrastructure development and then therefore growth coming from that. It seems to be a model that worked well in China. But then China is a country of 1.4 billion people. China is a country which had massive, like you said, trade surpluses, which was the manufacturing capital of the world, the factory of the world, where people had money to potentially start using those roads and subways and buy those apartments eventually. Sri Lanka is not that large. Many African countries are not that large. Philosophically, does the model make sense for some of these countries?
I don't think the answer is necessarily an easy yes or no. So it's all in the details, right? Of what does debt finance development look like. So a couple of things that are difficult and risky about debt finance development. One is, how transparent are these transactions anyway? And one of the things that actually has gotten countries into trouble over recent years has been a shift that has taken place in how China is doing this with BRI. So, previously, pre-BRI, the primary financiers were these policy banks, two of them, and then the primary recipients were governments. During BRI, what got messy is that now 70% of China's overseas lending is directed by state-owned companies, state-owned banks, these joint ventures. And so they're coming from a broader cast of characters. And then on the recipient country side, you have more and more of the recipients of Chinese financing being companies, not governments. But these companies are taking on debts that are backed by the state. So, in a case like the Maldives, if you have this was under the prior administration, but, if you have a crony of the president that says, I want to build a resort, I'm going to borrow from China, I'm a private sector company, but guess what? The Maldivian government has my back. They're going to repay in the event of default. What this means is that you've got tons, increasingly mounting debts and obligations that have to be covered by the government but aren't on the public's balance sheet. So part of the challenge here is the lack of transparency and the fact that you basically are mounting up these obligations without seeing them. So I think moving forward, that has to change because that's a major vulnerability. I think the second challenge with this is that it turns out that governments are really poor at estimating the costs and benefits of projects across a total life cycle. So if you are in a world where you can accurately assess the amount of revenues coming in from a debt finance project, you might say it's actually worth it to access debt to finance this if you can cover the cost of servicing the debt. But unfortunately, what happens in places like Malaysia with ports, or in Sri Lanka with airports, or you can pick your country in the world, there are overly rosy projections of the revenues coming in, and then you find that actually that was incorrect. And so now you're kind of rushing to repay. So I think getting that right is really difficult. And then finally, I think it's about scale. I think you alluded to it. Some countries are smaller. China is much larger. And so, one of the things that's most concerning is to see how many countries are actually seeing their total debt obligations to China becoming more and more of their GDP. So 5 countries today have debt obligations to China that is above 50% of their entire gross domestic product. That's way too much for a small country. And so I think it's about, yes, debt finance development can be useful even for small countries, but it's under certain conditions. It needs to be transparent. It needs to be on book. It needs to be based on like sound cost benefit analysis of what you can actually feasibly repay. And then it needs to be in proportion to your likelihood of your gross domestic product, your economy being able to absorb all of that.
Fascinating. Thank you so much for shedding this much light on what's been happening. I think there's so much narrative, so little conversation with actual data and clarity. I think this has been truly, truly beneficial to me, and I'm sure that to all our listeners also, it'll help them sort of disambiguate all the narrative there and actually make sense of what's happening. Samantha, thank you so much for joining us.
My pleasure. This is a great conversation, and I hope it sparks some discussion for your listeners.
Indeed. Thank you so much.
Thank you.
If you liked our show, don't forget to check out other interesting podcasts on the IVM network. You can tune into them on the IVM Podcast app, ivmpodcast.com, or wherever you listen to your podcasts. You can also follow IVM on social media. The handle is @IVM Podcasts on Twitter, Facebook, and Instagram. And hey, if you'd like to dive into Takshashila's research on technology, strategy, and economic affairs, check us out at our Twitter handle @TakshashilaInst or our website takshashila.org.in.